Assalamualaikum warahmatullahi wabarakatuh. Hello, my name is Salma Alisha Sahdiya with NPM 234120046 from Accounting Class 23A Advanced Financial Accounting course. Here I will explain the material investment in equity instruments. Definition. An equity instrument is any contract that gives residual rights to an entity's assets after deducting all its liabilities. An equity instrument investment represents an investor's stake in common, preferred or other capital instruments. The party acquiring the stake is called the investor, while the party issuing the shares is called the investee. Investment objectives in equity instruments. 1. Control, to gain significant influence or control over the company invested in. 2. Income, to receive regular dividends. 3. Growth, to gain capital gains from rising stock prices. Types of equity instruments. 1. Common stock. Common stock provides ownership rights and voting rights at the general meeting of shareholders. Holders of common stock are entitled to receive dividends and get a share of the company's assets in case of liquidation, after debts and preferred shares are satisfied. The benefits come from share price appreciation and dividend distribution. 2. Preferred stock. Preferred stock gives priority in dividend payments and claims on company assets over common stock. However, preferred stockholders usually do not have voting rights. Dividends on these stocks tend to be fixed and more stable. 3. Other equity instruments. These instruments include warrants and stock options, which give the right to buy shares at a certain price, as well as units in equity mutual funds that allow investors to own shares through professionally managed funds. Classification of equity investments. Without significant influence, less than or equal to 20%. If the investor has less than or equal to 20% ownership and does not have significant influence over the invested entity, the investment is classified as a financial asset. Usually recorded using the fair value method or cost method. With significant influence, 20% to 50%. If the investor has significant influence over the invested entity. For example, through ownership of between 20% and 50% of the voting shares, then the investment is accounted for using the equity method under PSAK 15/IAS 28. With control of greater than 50%. If the investor has control over another entity, usually through owning more than 50% of the voting shares, then this relationship is referred to as a parent and subsidiary relationship. In this case, the financial statements should be consolidated as per PSAK 65/IFRS 10. Methods used in equity investments. Cost method, for small holdings without significant influence. Fair value method, for trading or available for sale investments. Equity method, for holdings with significant influence, 20 to 50%. Consolidation, for majority ownership, greater than 50%, and control of the investee company. Equity investment risk. Equity investment risk covers a wide range of potential losses that can affect the value of an investment. One of the main risks is market risk, which is the possibility of stock prices falling due to economic, political conditions or investor sentiment. In addition, there is liquidity risk, which is the difficulty of selling a stock quickly without significantly lowering its price, especially for infrequently traded stocks. Issuer risk also needs to be considered, which is the risk stemming from the poor performance of the company in which the investor has invested, such as declining profits, ineffective management, or operational failures. Investors need to consider and manage these three risks before and during investing in equity instruments. That's all I can say about the material investment in equity instruments. Wassalamu alaikum warahmatullahi wabarakatuh.